Welcome to the InterMarket Analysis Update. This is being prepared Sunday, September 25th, where we'll look at different markets and see how they're interacting with each other to see if we can get any clues as to what is happening in the stock market. This is being prepared for Monday, September 26th. First of all, we like to look at valuations just to see how things are going there. And when we look at the trailing 12 months, that's the red dotted line here, and we are starting to come down below that. So we're not extremely expensive right now. We're just kind of expensive currently. Now, please remember, this is the trailing 12 months. This looks back. The market looks forward to earnings estimates, and they tend to be more optimistic, and we're not as overvalued looking forward. But we like to look at this on a historical basis just to see how this black line, which is the S&P 500, how it acted over time when it was expensive, fairly valued, or considered inexpensive or cheap. And then down below, this is the spread between the current price of the S&P and the expensive line. And as prices have been coming down, this has thrown this more into a favorable reading currently. And here's a historical chart going all the way back to 1980 and different events that have happened along the way and how the valuations have changed over time. I'm not going through the possible positive scenarios. These are meant to really kick into gear when the market's going up, and we're not going up right now. We're at a real down trend right now, but we might be getting to a place where we're hitting support as well as seeing some oversold indications with our other charts. Please watch the full-length video of the daily video update or the weekly video update to have more information about that. I do update these possible positive scenario charts in every daily video that I do. So if you want to check on those, that would be a good place to find out about them. Let's first look at growth and value. Here's just the pure growth index, and it has been declining. This red line is the 200-day moving average. The blue line is a 50-period moving average. The blue line is below, so that's a negative trend, and price is below both of these moving averages. So we're seeing a lot of weakness in growth. What's causing a little bit of concern now is value has been holding up better. It was doing much better earlier in the year, but now it's starting to break down too. And that's a concern for the markets, because if you were seeing losses in growth, well, you could switch over to value and you might even see some gains, if not lesser losses in that type of index. Well, now we're seeing both of them start to decline, and that's giving investors very few places to go for safety. Really, the only thing that's looking good right now is the US dollar, and I'll show you the chart of that. This is when we take a ratio of the two, growth versus value. That's the top chart, showing how growth has been underperforming. Value has been outperforming, but has been showing some recent weakness. So we want to keep an eye on these. This is another look at that same measurement, looking at different indexes, where we show that growth had been trying to come back, but has been seeing some weakness and is in an overall downtrend. Here's an inverse of that same chart showing how value, even though it's having some weakness too, it's still outperforming growth. This is another look using ETFs where growth is still showing some weakness and in a downtrend. And here's an inverse showing where value is still in an overall uptrend. But you probably, if you're using this as part of your decision-making process, you probably want to keep an eye on just the just the value index, because it's really starting to break down as well. Then we look at the S&P growth index versus the S&P value index, and it just shows again how growth has really been underperforming. Some other markets, here we have the 30 biggest US software companies. This is tech, and after trying to come back, has been really falling down, and we're getting down to this area where this might provide support, or if we break through this, that could suggest a continuation of the technical breakdown. Here's a look at the CRB index on the top. This is a monthly chart, And even though it's still in an uptrend, it's starting to show some weakness. And then we have the inflation area against the deflation ratio. And it shows that inflation has really been going down as deflation possibly could be picking up. Then we look at the Baltic Dry Index. This helps us to measure inflation another way by how much does it cost to ship dry goods from one place to another, generally through the Baltic. And there's a whole basket of things that make up this index. When it's going down, that suggests that inflation is lessening. And it's been in an overall downtrend, but lately it's been starting to go back up. Here's the CRB index with a daily chart, how we're still in an overall uptrend, but we've been seeing some weakness. And if we continue to see prices fall below the 200-day moving average, we might eventually see a death cross here. And this is another area where people have been getting into because it's been going up. Well, if this is starting to break down and value is starting to break down and growth is already broken down, where do you go? And that's the big question that people are playing with right now. Just to give you some ideas of prices and how they're moving, corn is starting to go back up, but it fell down recently. Sorry, I had to clear my throat there. We're also seeing aluminum really start to come down. And these things are affecting, these real declines like this are affecting the CRB index, but it's also potentially helping out the inflationary situation. Heating oil has been coming down, even though it's still pretty high. Gas, and this is what the politicians are really focused on right now because it's in our face all the time and there's an election coming up. So they want to do whatever they can to lower gas prices with the hope that that might entice folks to reelect those that are in office or elect those who are seeking to get into office. So, but this is really being manipulated now. A lot of this can be based on the fact that the government is taking a lot of reserves out of our emergency reserve pile that we use just in case there's some kind of military action and we need that for our military. Well, the only problem is it's depleting that. And if nothing bad happens, well, that needs to be replaced. And it's probably going to be at a lot higher prices than it was replaced at previously. So that could also be negative overall. But since our politicians like to kick the can down the road most of the time, they're just worried about November right now. So they really want gas prices to come down. So there's been a lot of effort in doing that and a lot of self-promotion when this happens. Natural gas has also been coming down a little bit. Oil has been coming down, dropping below 80. We're at 78.74 now. Wheat has been going back up slightly. And then fertilizer, we want to keep an eye on this because it's the basis of an agricultural society and it just costs them more. The more fertilizer costs, the more it costs farmers to grow the things that need fertilizer. So that could eventually work its way over into the high prices that we're already seeing when we go shop for food. Lumber is still in an overall downtrend and is starting to fall even further than where it had been. But the dollar, man, look at this, almost up to 113, just a nice solid uptrend. There's so much uncertainty now in the globe. There's problems in Japan, there's problems in Europe, there's some situations going on even in the UK. And even though the US has its problems on a scale, they're considered not necessarily as bad as some other areas. And so where do these countries flock to when they need to put things into a currency? They're going into the dollar right now. And that's why we're seeing a lot of strength. There may come a day when the dollar just turns and goes down, 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 down. But that day is not today. This may happen into the future. But right now, the dollar is really performing well against the other currencies. This is also part of the problem with the stock market because companies in the S&P, they do about 40% of their business overseas, and there's conversions that take place. And when the dollar is higher and the other currency is lower, that means they get less dollars when you convert them. This can also impact the import-export balance back and forth, making it more expensive for other countries to buy US products. And that can ultimately feed into companies' earnings, which then feed over into their stock prices. And these are some of the growth concerns that we've been talking about, which is really pushing prices of stocks down, in addition to all the interest rates going up. Here's the euro on top, showing how it's really been declining. It's actually under the dollar now, where the dollar has gone above the euro. So if you want to go to Europe and you can afford it, and you might be pretty cold this winter, and you might have to pay a lot for food and everything else, well, at least you're going to get a pretty favorable exchange rate. So just something to think about. And the British pound, it's down to 108, 109 to the dollar. And that's as low as I've seen it in a long time. So, hey, you want to go pay some late respects to the Queen or do some touring of Britain, you'll get a more favorable conversion rate, but you're going to pay a lot more once you get there. Then here is the Japanese yen on the top. It's really been having some trouble. The finance minister in Japan made an announcement this past week that they were going to come in and give support to the yen, which means we're going to come in and buy a bunch of yen. Well, that didn't really help out all that much. That gave a little bit of support to the Japanese yen, but not very much. We'll have to see if there's any follow through to that. But in the meantime, the Japanese yen continues to fall. The euro is really having some trouble too, and that is why the US dollar is going up. Copper is kind of going sideways right now. Typically, when copper is going up, that means it's seeing a better economy in the future. When it's coming down, it's seeing a weaker economy. Well, we've been bouncing pretty much sideways. It really doesn't know what to think right now. Here's the copper to gold ratio, which has really been going down, and gold's been suffering, continues to suffer. And with copper just kind of not really doing much, this whole ratio is really turning down currently. And then here's a long-term look at that same chart where we compare it to the 2-year yield, which is just going to the moon these days. It's at 4.2%. My goodness. So interest rates are kind of out of whack right now. We have some shorter maturities that are higher than longer maturities, and we've got the 2-year up over 4%. My goodness, it's pretty crazy times right now. Gold, which should be going up, but is not going up because of dollar strength, it continues to be in a pretty solid downtrend. Silver went sideways there for a while, but then has seen some recent weakness. Looking at some indexes, the CRB to the S&P 500, it's still in an overall uptrend, but what's keeping this up is not that the CRB is going up, it's that the S&P is going down. And so this ratio is still maintaining a positive trend. And here's an inverse of that same relationship. Here's the NASDAQ 100 to the S&P. NASDAQ is growth. It's really been underperforming the S&P, which is also struggling. In a good, healthy environment, when we're seeing stocks going higher, we want to see this ratio really going up. And it's doing the opposite of that right now. Some other stocks. Here are the mega cap. These are the really, really big stocks. The Facebook, Google, Apple, Microsoft. They are really suffering right now and getting down to the point where they may be testing support at some point here. The S&P 100, which actually, this was a little surprising. It's spent a lot of the week actually showing some improvement. It was down a bit on Friday, but it was doing okay, even though it's still in an overall downtrend. Here's small caps, which are really underperforming the S&P 500. Here's low volatility stocks. They've been holding up a little better. They're still down, and they've been going above and below and above and below. And we've got a death cross, then a possible golden cross, but now prices are down below both moving averages. We were down 1% on Friday. So there's just an awful lot of confusion right now. The S&P low volatility ratio to the S&P itself shows that the low volatility stocks have been holding up better than the S&P. And these are what folks start to really get into. But you probably, if you're into this, if this is what you implement, you're probably going to want to keep an eye on this index because it's really been seeing some recent weakness, just not as much weakness as the S&P. The Dow Jones Composite is in a pretty solid downtrend. We have the Dow, the transports. They both made 52-week lows this past week, but the transport's doing it first. Utilities are holding up okay, but even they're having a little bit of trouble. but they're still doing better than the S&P 500. Here's Dow theory showing how we did finally make a new, and I say finally because we were seeing a negative divergence as the trannies were going lower and lower. The Dow had not made a new 52-week low yet. And even though the utilities are showing some weakness, they're still a long way from making a new 52-week low. And this is just a longer term look at that same chart where we have the Dow, the trannies, the transports really showing more weakness currently, but the utilities are, even though they're weak recently, they are holding up better. FANG stocks, the Facebook, Amazon, Apple, and they've added some and changed the acronym. It is also having some problems as of late, as is ARK, and it looked like it was really trying to break out here, but nope, it really broke down, and that's a failed breakout, and it's coming down and could be testing support pretty soon. Looking at bonds, we're not getting any support there. We're starting to make new lows based on the total bond ETF, and we're breaking below the COVID lows with the world bond index. The stock to bond ratio, it turned down a little bit, but still, for the most part, stocks, even though they are not doing well, they're doing better than bonds. This is one of the worst years we've seen in bonds in a long time. Here's bonds. Shorter maturities are showing a little bit of recent strength, but still not really doing much overall. Stock to bond correlation, both are going down, so they're having a tendency to move in the same direction now. And the corporate bonds are also seeing weakness based on price. The S&P 500 to the 10-year yield, S&P is going down faster than interest rates are going up, so that's why we're seeing this really decline. Junk bonds also coming down and possibly testing support, still in an overall downtrend right now. But when you compare junk bonds to treasury bonds, they are still outperforming, even though both are really struggling right now. And this is just this convoluted spaghetti mess up here, where the blue line, that's the 2-year yield right in here. And look, it's leading the way right now. And then we have the 5-year, which is green, and then the 10-year, and then you don't get to the 30-year. It's like in fourth place right now, which this means the yield curve is all messed up right now. We have just a lot of mishmash of different lines. And then internationally, we saw in the EU, they raised interest rates, and in the UK, they raised interest rates. And for the first time since 2015, they actually have positive interest rates in Switzerland. But Japan decided not to raise their interest rates, and that's why their red line here is so low. But you can see how we're really spiking up when we're looking at the different 10-year yields. Looking at some sectors, the utilities continue to outperform the S&P, or said another way, the S&P is really underperforming utilities. We want to see this turn and go back up to get confirmation that it's giving some support to the S&P 500. Staples, also, this has been an area that people have flocked to for safety in 2022, but it's starting to see some weakness. And we see the blue moving average moving below the red moving average. That's a death cross. It tried to cross over positive, but is now going back negative. Energy, which had been doing really well, is now starting to show some weakness, but it's still in an overall uptrend when you compare it to the rest of the S&P. Tech is also really struggling and in a downtrend. Semis, which is a big part of tech, also coming down to this level. Is it going to break below that, or are we going to find some support? And if you watch the other videos that I do, we're kind of at a point right now where we're either at or near a point where if the market's going to bounce, it's going to have to do it in the next session or two. We're seeing a real coming together of sentiment and oversold conditions and support. And the pattern that I've been seeing over the last week is we've seen early day weakness when the market first opens, and we're seeing late day strength. And sometimes that's what the smart money does when they're getting ready they're entering into the market eventually to take prices higher. So we'll just have to see. We're seeing a lot of these testing of support in many, many different charts. Now, if we break through this and fall down, then things could get even worse than they've already been. The tech to the S&P has really been underperforming. Some other areas, here's growth, which has really suffered, and bonds, which have really suffered. And so we have growth actually doing worse than bonds. The 10-year yield to the tech sector just shows how interest rates have really been going up as tech has been suffering. And then here's an inverse of that same chart where tech has really been underperforming. Here's discretionary, which had been doing okay up until about a week or so ago. Well, it's really falling off right now. Even though it had still been in a downtrend, it was kind of sneaking up and doing better than some of the other sectors. That's pretty much all gone now. And then here's staples, which is continuing to outperform discretionary. Energy, which again has been doing good, but has seen some weakness compared to tech. It's really been falling lately, but it's still in an overall uptrend. And gold, which has been suffering, and the S&P, which has been suffering, but gold's been hanging in there a little better than the S&P as of late. And the gold to the dollar, well, we've got the dollar really going up and gold going down, so that's why we're seeing a real decrease here. High leverage loans, they continue to fall as well. If we get into rockier economic times than what we're already in, you could probably continue to see this fall as some of those high risk loans really are jeopardized. This is the kind of the freaky chart to me. See how oil's been up here, way up here? Look at, it's almost going to fall down. If we see what we're seeing now, if that continues, oil could actually go underneath the dollar, and we could have the dollar being the best performing asset of 2022. It'll be interesting to see if that actually happens. But it really has been falling off lately. It was up 32, 33% just a couple of weeks ago, and now it's down up only 20%. But this looks a little more dramatic, where we have gold, stocks, and bonds continue to be negative going back to the beginning of the year. Some indexes, when you take a broad look, we are seeing weakness. When you take a 5-period simple moving average of the highs minus the lows, we're really dropping down. We're not generating a new signal yet. This is one of the possible positive scenario charts that I use. When we go really extreme, sometimes that will give some support to the S&P 500. We're just watching this now because it's showing weakness. The S&P 500, or excuse me, the S&P 600, which are the small caps, this could potentially be positive. Even though we're declining, we're coming down to this S2 level, and we're still just slightly above that. Can we get some support off of that level? If not, then things might turn even worse. The mid caps also just above this S2 support level. See, we're seeing a lot of different support levels all coming together. We're just about at support with the Dow. We actually broke down and made a new 52-week low with the Dow, but you see how we closed well off of the high, or excuse me, well off the low and right near this S2 level. The NASDAQ is right on S2 currently, even though it's negative. NASDAQ 100, just a little bit above S2. And this S means support. And then the Wilshire, it's still a bit above, and it's really hard to see because I've got the volume bars in here. But we're actually, if you can see my cursor, we're right there. We did break under S2 on this chart. And all stocks are showing a lot of weakness and are in a downtrend. Emerging markets continue to be in a downtrend. Internationally, everything's going down. China, emerging markets, Europe, Japan, and of course the US. Bitcoin is even having trouble. It's down below 20, getting into the 18s. On good days, it might get back above 20. On not so good days, it has a tendency to fall down below 20. Some correlations, we're seeing really strong inverse correlations in some areas. When the dollar is going up, the S&P is going down, and that's why we're seeing a pretty strong inverse correlation currently. We're seeing both stocks and oil going down right now, so they have a pretty strong correlation where they're going in the same direction. And here's the S&P to the 10-year going in opposite directions. And tech to the 10-year, also opposite directions. S&P to the 2-year yield, as that thing just goes to the moon. Also, this is just about as high as you can get. And because rarely do you ever hit a +1, that means they're totally going in the same direction. A -1 means they're totally going in the opposite direction. And here we have a -97. So you would think something might happen to change this. We'll have to see how the week plays out. So if you've watched these videos before, there's no change. We have energy, CRB index, and interest rates. Even though all of these are showing some, well, energy and the CRB are showing weakness, interest rates are just kind of blindly just going up and up and up. And then all the negative areas, this has not changed either. So yeah, it's really hard to find a good place right now. That's why a lot of folks are in cash. And there are futures contracts on the dollar, and some folks even do that, and they're seeing pretty good returns. Folks that have been riding the energy wave, they're starting to get a little bit frustrated. And of course, stocks have been very frustrating in 2022 as well. So thank you. Please feel free to check out any of the daily videos that I post. There's a weekly video available, and I hope you find this very useful.